What the U.S. economy could use right now are a few animal spirits, a little emotional optimism to reignite demand, spending, growth, and ultimately jobs. So we invited the man who literally wrote the book on animal spirits, Robert Shiller. Dr. Shiller is a professor of economics at Yale University, and he co-wrote the book Animal Spirits: How Human Psychology Drives the Economy and Why It Matters for Global Capitalism. He joins us this morning from New Haven, Connecticut. Bob, great to have you back here on the Inside Track. Let's talk about confidence. It is what's lacking in the economy right now. Just about everybody would agree. Larry Summers, the former Treasury Secretary, wrote about it in an op-ed in the Financial Times yesterday, saying, unless we find a way to recover confidence, the U.S. economy faces a Japan-style lost decade, and most people out there have come to understand what that means. Zero growth, deflation, and absolutely no confidence whatsoever. Do you agree with Dr. Summers?
Well, in essence, although I would come to the defense of Japan, over the last 2 decades, the growth rate of real GDP in Japan has been between 1% and 2%. They've been growing. Disappointing. Moreover, deflation was intermittent. It wasn't consistent. So I think he's overstating it, and I think, yeah, we do have that risk. I mean, I wouldn't go to predict that, but it's certainly a risk. Japan is an extreme among countries, but it does reflect what happens to a country after bubbles burst, what can happen. So I think it is a risk, and Summers is right to worry about it.
Dr. Shiller, back in 2009, you wrote that more credit was needed to revive animal spirits, and we have seen more credit extended. Look at the pace of high-yield bond issuance, for example. The Fed survey of senior loan officers shows that lending conditions are beginning, at least during the first quarter, they began to ease. We've seen investors more prepared to buy long-term debt. We've seen spreads compress over the course of the recovery out of the financial collapse. All of this would suggest that credit is much more available than it was 2 years ago. So why are the animal spirits in hibernation?
Well, I think that the economy is a complicated thing. A lot of things go one way and others go the other way, and the net effect is the sum of all these things. So there are reasons to think that the economy will continue to grow. Obviously, the stock of housing hasn't been augmented, and the population is still growing, so you would think that we'll catch up with our supply and come back. But the fundamental problem, yes, is people don't think in terms of econometric models. And the buffeting they've had, and the fact that they're really suffering. Many people are unemployed, they're losing their homes. It has just poisoned the atmosphere, and it's led to a sense of discouragement. And that, on top of all the other factors, is the dominant influence at the moment.
Well, you can't blame people for not thinking according to econometric models, of course, and you would know that as a behavioral economist better than anybody. But Dr. Shiller, it's a simple question. Can the economy regain confidence if housing prices don't recover?
Well, housing prices haven't been a consistent factor in confidence. If you plot confidence and plot housing prices, they don't relate that much. I think but this particular recession, the one we just had, was a housing recession. It was driven substantially by the crash in home prices, which started in 2005, 2006. And after it had gotten to a certain degree, then we started seeing financial catastrophes appearing. So it would be really good for the economy if the housing market were to recover. Unfortunately, I worry that we'll see the opposite of that.
You have said that what we're suffering from right now is a hangover, effectively, from the pervasive optimism that we all enjoyed, I suppose, for a period of time up until 2007. How long do you think before it goes away? Can you equate that at all with your study of long-term cycles and mean reversion?
Well, it's hard to be quantitative about it because there aren't that many such events. The U.S. has had depressions in the 1830s, 1870s, 1890s, 1930s. That's it. That's the whole history of them. Some of them last a long time. The depression of the 1870s, 6 years. Of course, we're already some years into this one, so I don't think we have any clear statistical way to present the outcome. I just worry that it could last for more years, but I don't know.
Dr. Shiller, we're talking about confidence and how the absence of it, or the absence of animal spirits, is hobbling the U.S. economic recovery. You have argued passionately in the past for stimulus, that stimulus is the way to reignite confidence. Many people would argue that we can't afford any more stimulus right now. So if we can't, if that's true, how do we revive confidence if the government can't afford to spend more money?
Well, you put your finger on the problem, which is a political problem. And it's the same problem that appeared in the late Depression of the 1930s. After the 1937-38 recession ended the growth, the recovery, people were in no mood for more pump priming, as they called it. And for the same reason, they're worried about the national debt. So I don't know what to do about the political problem. It's there, and it's real. And that's one reason for pessimism. Forecasting the economy, unfortunately, means forecasting, in part, politics and forecasting what kind of stimulus we'll receive.
But Dr. Schiller, are you certain that Keynesianism, that is the doctrine that you, broadly speaking, subscribe to, the idea that stimulus at this kind of moment in economic history works, is still valid? It has gotten us this far, but the economy really isn't back on its feet.
Right. Well, I'm not certain of anything. I think it works. I know that there are doubt that people will express that the regulatory changes have created an atmosphere of uncertainty which hampers business. People said that in the Great Depression, the same thing. There are other factors. So it would be nice if the regulators could get their act together and clarify just what the new rules are. That's another thing that's hampering, is holding us back.
But Dr. Schiller, before we go, if there's one thing that you would recommend either the President, the Treasury Secretary, or the Chairman of the Federal Reserve do, what is it?
Well, based on my 2008 book, Subprime Solution, I would like to see more important reforms of the financial sector that democratize finance, that let people know that, we have 11 million homes underwater. Something is wrong. Let people know that we're changing the mortgage institutions. We're replacing Fannie Mae and Freddie Mac with something better and more new kinds of mortgages, new thinking. And I think that would help promote confidence. That worked with the New Deal. We haven't been as aggressive in modernizing our financial sector and promoting, I would call it the American dream, that we are the most financially sophisticated and advanced country. So let's move ahead. In my mind, that would help confidence.
Dr. Schiller, thank you, as always, for joining us. Bob Shiller, professor at Yale University. He's also one of the two men behind the Case-Shiller Home Price Index.